Good afternoon. Thanks so much for joining us. We're gonna wait just a few minutes, see if a couple other people are gonna join us here. And we'll get started in just a minute or so. All right, we see a couple other people join in. Welcome. Thanks for joining us. All right. Well, we'll go ahead and get started here. Thanks so much for coming to our new webinar. This is WaterStone's first attempt at a webinar, and we're a little bit behind the game, but excited to talk with all of you today. So today's topic is going to be charitable pooled trusts. Many of you are probably a little bit familiar with these. We want to go into all of the details about exactly how this works. We like to think about these trusts in really three main ways. We're prioritizing income, we're minimizing taxes, and we're optimizing giving. All right. So we're gonna learn a lot about CPTs today, also called pooled income funds. We're gonna talk about that historically high tax deduction, almost double that of a CRT. We're gonna talk about who can manage the assets within a CPT, what kind of assets you can contribute to a CPT, and how to receive that lifetime income stream. I'm going to kick us off a little bit with just who is WaterStone. WaterStone, of course, is trustee and administrator of all of these charitable pooled trusts, pooled income funds, but just wanted to share a little bit about who we are and why it works so well with WaterStone. So WaterStone was established in 1980. So we just celebrated a big anniversary of being around for 40 years. We are a Christian foundation. We are our official name is Christian Community Foundation. We are a public 501c3 organization, and we partner with givers, advisors, ministries to really just get the most to the kingdom. We provide trusted counsel and customized, innovative giving strategies. Of course, this pooled income fund, the Charitable Pooled Trust, is one of those strategies, along with CRATs, CRUTs, CLATs, CLUTs, all the different things, and of course, donor advised funds. We call ours giving funds. We have expertise in non-cash assets. So we have MBAs, CPAs, a JD, and MAI. We have a very small staff of about 17 people. We have a lot of expertise in these areas. So Chris and I, who you're going to hear from today, we are the two CPAs in the office. And so we really specialize on receiving gifts of real estate, privately held business interests, agriculture, kind of all the weird stuff. In addition to donor advised funds, we also do charitable trusts. And our main focus is to multiply giving, minimize taxes, and heighten the joy of generosity. All right, just a little bit of an introduction into Chris and I. Of course, my name is Stephanie Hoff. I am a CPA, and I am our senior gift strategist here at WaterStone. So I am coming up on 4 years with WaterStone. My primary focus is those gifts of non-traditional assets. So donors that are working to contribute gifts of real estate, privately held business interests. It's pretty fun. I of course have my degree in accounting, originally from the Midwest, spent my time in Illinois, Indiana, and Michigan, and of course love living here in the mountains in Colorado Springs now. And Chris Start is here with me. Chris is our VP of Finance. Chris is also a CPA. He helps with a lot of these non-traditional assets and also runs all of the finance for our $850 million foundation as well. Chris has many years of experience working with charitable trusts. Also from the Midwest, we've both got some Illinois connections. Got his Master's of Science and Accounting from the University of Illinois, and has worked at Moody Bible Institute and Northern Trust and Bank. So we're both going to kind of take turns here as we start talking about charitable pooled trusts. All right. Let's just start basic. What is a charitable pooled trust? The IRS terminology for this trust is a pooled income fund. We didn't like that name, so we came up with our own name. We call it the Charitable Pooled Trust, the CPT. But again, that formal terminology, when you're looking it up in the IRC code, is a pooled income fund. Pooled income funds are nothing new. They started in 1969, so they've been around for quite a while. It is an official charitable trust. There's the IRC code for you. Charitable pooled trusts are interesting because they need to be established and maintained by a qualified nonprofit organization. So this is very different than a charitable remainder trust, where the donor can serve as trustee. Within the pooled income fund, the charitable pooled trust, WaterStone has to be the trustee and administrator and also the remainder beneficiary. So it's a very unique kind of charitable trust. And it acts kind of like a mutual fund. We are pooling resources to invest resources of multiple donors together. So we need at least 2 or more participants in each of our CPTs. So this means 2 or more donors. This could be a husband and a wife, but we truly are trying to pool resources together. So if you are an investment advisor, we could potentially open up a new pooled fund for you to have your own investment strategy and manage the assets of your donors. All right, there's 5 main benefits of a charitable pooled trust, and this will kind of help you fully understand exactly what this tool is. So first and foremost, it is a trust. It does provide a perpetual lifetime income stream. So the pooled income fund, it is going to be a lifetime income stream. It's unlike charitable remainder trusts in that you're not going to have a term of years trust. It's always going to be lifetime. Income is distributed quarterly. So this is also different than other kinds of trusts where you can choose to receive an annual payment or monthly payment. These are going to be quarterly payments, and it'll be based on your portion of that trust since we have multiple donors. It's going to be a variable income stream. So whereas charitable remainder unit trust is going to be a more consistent income stream, the charitable pooled trust is more variable because it's going to be based on the performance of the investments, and the income distributions are going to be subject to tax. So not only do you get a lifetime income stream, but the donor also receives an immediate charitable tax deduction. Chris is going to talk a lot about the details of this tax deduction and why exactly it's so large, but you will receive an immediate tax deduction based on a low valuation rate. It's often double that of a CRT. And again, we'll do some comparisons here for you. There is a favorable tax treatment. So if we are contributing appreciated securities to a pooled income fund, we are going to be able to bypass all of the capital gains on that contribution. So the ability to avoid that capital gain and also receive an immediate charitable tax deduction is really a double tax benefit if you're donating appreciated securities. Similar to a charitable remainder trust, the beneficiary of the CPT is going to be a donor advised fund at WaterStone. So you'll be able to make a future gift to charity. It's really great that we can partner with the donor advised fund side of our business here at WaterStone to allow the donor all of the flexibility that comes with the donor advised fund for making that future gift to charity. And then, of course, this is going to avoid all estate taxes. So assets contributed to a CPT are going to be removed from the value of the estate. This could potentially limit the effect of federal estate taxes and will allow the trust to pass to charity without going through probate.
All right. Well, I'm going to speak for a little bit now and talk about some of the histories of pooled income funds or CPTs, and then talk about why they're such a great deal today. So Stephanie mentioned these have been around for a long time. They began in 1969, and they used to be very popular. And the reason they were popular is they were very easy to administer compared to a charitable remainder trust, which we think many of you are familiar with. With a CPT, you can just have one tax return and one investment and have hundreds of participants. So you can have smaller participants. So a lot of charities, these were big in the 80s and 90s and early 2000s because they were a way to simplify planned giving. You didn't have to do multiple trust agreements. You just had one pooled income fund, and you could have multiple participants, and people could join with smaller amounts. So they continued to be a great tool for charities for a long time. And one of the biggest benefits was rates were so high back in the 80s and 90s and early 2000s that you could earn a very reasonable return from being in safe investments, from government and agency bonds. And what the charities liked is you'd preserve all the corpus for charity. You'd earn a decent return to keep the beneficiaries happy, and then when they passed, you'd have the full principal to go to the charity. What in the late, around 2010 and beyond, when rates started to fall, these became not such a great deal, and charities moved away from them because donors weren't that excited about giving their money to this and getting the deduction, but only being able to get a return of 1 or 2% in government bonds. So, around the late 2000s, before 2010, these started to fall out of favor. But that's about the time that we started thinking about these, and some other folks did, because of some young fun things that we're going to talk about. These became a real great opportunity. So you want to go to the next slide, Steph? So the way the deduction works on a pooled income fund is if it has history, you look at the highest rate of return over the last 3 years. And that's what you use to calculate the rate of return. And that's how you're going to come up with your charitable deduction generally. So if you think as a CRT, it has a fixed payout percentage. It's got to be at least 5%, and it can be higher depending on the age of the participants. In a CPT, it's just variable income, whatever is earned. So the way the IRS does this is it looks at your last 3 years, and whatever your highest rate of return has been over the last 3 years is what they're going to assume the rate of return is going to be going forward. And that's how the deduction is calculated. With a young fund, a fund that's less than 3 years old, the IRS comes up with their own formula. And that's based on the IRS, the IRS applicable federal midterm rate. And so that's, they put that out every month. That's also used as kind of a discount rate in CRTs. But the way the formula works is it looks at the average of the rate for the year minus 1, and that's considered to be the rate for the year. So, for example, this year, the rates jumped around from anywhere from 0.6 to, in November, to the high of 1.4. So for the year, we're going to be at about an average of 1%, between 0.6 and 1.4. If we average it out, we're at 1%. Well, to come up with the valuation rate for this year, you take the average rate minus 1. So it's a little bit of a complicated formula, but 1 minus 1 is what, Stephanie? She's a CPA. 0. So the rate this year is 0, but the IRS uses the same 3-year calculation. So, for 2022, we'll have to look at what the average rate's been in 2019, 2020, and 2021. So I can just tell you in spoiler, for 2020 and 2021, because interest rates are so low, the rate has been 0. But in 2019, the rate was 1.6. So that's what we're expecting the rate to be for CPTs next year. This year is 2.2, which goes back to 2018. So why don't you go to the next slide? So that's a lot of numbers. I'm a CPA. I get kind of excited about this stuff, but that's a lot of stuff you don't need to know. What you need to know is look at this cool chart we've got here. So back in 1990, the rate on the young fund was 9.25%. If we had 2 65-year-olds contribute, they would have gotten a 14% deduction. If we just pick another random year of 2003, the rate for a young fund would have been 6.6%. So if 2 65-year-olds were to contribute, they would have gotten a 25% deduction. What we've seen in the last 10 years is rates drop dramatically. So in the last 10 years, the rates have kind of moved around, but they've been between 1.2 and 2.2%. And if we look at the rate low was 2017 at 1.2%. two 65-year-olds will get a 76% deduction. So if we just stop and think about that for a minute, that means if somebody were to give $100,000 at age 65, they'd have a life expectancy of 20 to 25 years. They'd get roughly a $77,000 charitable deduction, and they'd receive income for life. When they pass, whatever's left in the fund would go to charity. So this is an amazing tool where you can get an immediate high deduction now, still get income for life, and be able to support your favorite charity. Just looking through here, this year we're at 2.2%. So for two 65-year-olds, it's about a 62% deduction. Next year, we're expecting 1.6, which will get us back to a 70% deduction. So going forward, obviously, we don't know exactly where rates are going to go. 2023, they could be even better. Rates could rise, but all we know is that the next 2 years, we have a fantastic opportunity to give to these and get a historically high deduction. We expect it to last several more years, but we don't know what rates will do. But we do know that for two more years at least, we have a great opportunity. So the next slide is just looking at the charitable deduction of a CRT, a charitable remainder trust, which many of you are familiar with compared to a CPT. So we also do lots of charitable remainder trust. We actually have about $220 million in charitable remainder trust. So this is a big part of what we do. We have roughly $55 million in charitable pooled trusts. So we do both of these, and we think they're both great tools for different circumstances. But right now, because of the tax deduction, CPTs offer great opportunity in the right circumstance. So just kind of looking at this tool here, if we had two 50-year-olds, your deduction from a CPT would be 2.6 times as high as it would from a CRT. If we go up to two 60-year-olds, it's twice as high. And one thing that's really neat about a CPT is you can get some younger folks involved. With a CRT, you have to have 10% left for charity. I just tried to look this morning, and currently with the current discount rates, you have to, if we had two folks, they'd have to be at least 39. Two 38-year-olds would not qualify for a CRT because according to the IRS tables, there would be less than 10% left. With a CPT, if we had two 38-year-olds, they'd get a 40% deduction and income for life for the next 50 years. So it's really a great tool for younger people, and we've had some really young people. You can do some tax planning. You can get your kids or grandkids involved. Similar to CRT, if the donor immediately has the kids be the beneficiaries, then we have a gift tax problem. But if we start with the donor and then add the kids, and you keep the right to revoke by will, then we avoid the gift tax, and it essentially becomes a testamentary CPT because you have the right to revoke by will. So, there's a lot of cool things we can do. And, the key with this is just talk to us if you have any questions, and we can walk you through the options.
Yeah, and feel free to be asking questions now. There should be a chat box on the right side of your screen. Feel free to type in a question there, and Chris and I can answer that as we go here. So we're already getting into the weeds on charitable pooled trusts, and so please don't hesitate to reach out with a question, and we'll make sure that we can answer that here. Get back to you if needed. All right, so now talking about just some of the specifics of exactly how does this work. So we like to think of a lot of our charitable tools here at WaterStone on the terms of how to give, grow, and then grant. So that's really how the donor advice funds work, where we're giving all kinds of assets, we're growing those tax-free, and we're granting them out to to the donors' preferred charities. This charitable pool trust is going to work the same way. It's just on a much longer period of time. So the give portion, we are typically going to receive gifts of cash or marketable securities in order to fund this kind of asset. So the charitable remainder trust we've been talking about, that can receive gifts of real estate and C Corp interest, a lot of other things. The pooled income fund, the charitable pooled trust, is really primarily more liquid assets. So we want a diversified portfolio because it is kind of almost a mutual fund where we're pooling resources together. We want any investor off of the street to be able to look at this investment and say, yes, I want to join this pooled income fund. And so if the only asset within this trust is a piece of real estate that we're having trouble selling, that's not a great asset for another party to be interested in joining this trust. So we are usually using cash or marketable securities. What this means is this is a great tool for a post-sale gift. So if we have missed a pre-sale gifting opportunity, you recently sold some real estate or you have recently sold your privately held business, this is a really great tool to use with that cash after the sale. You'll already need to recognize those taxes, but this is a really fantastic way to get a very large charitable deduction in the year that you need it, the year of the high income event. But you're also going to receive the lifetime income stream coming off of this trust for the remainder to go to charity. So, cash and marketable securities are truly what we are looking for to fund these kinds of trusts. The marketable securities, use those appreciated assets, use that appreciated Apple stock. We can completely avoid the capital gains once we sell it and liquidate it within and diversify the portfolio within the trust. The trust will not need to pay any of those capital gains. And again, you're receiving that historically high tax deduction today for the value that charity is going to receive in the future. That might be 20, 30, 40, 50 years away. And so it's pretty great to be able to get that tax deduction in the year that you need it. All right, grow. So now the trust has been funded. We are going to work with your choice of investment advisor to manage these assets. We do have several funds already managed by different advisors that you can join. Chris is going to talk about an example of one of those later, but we've also set up new investment strategies with specific investment advisors as well for their clients. So the CPT investments are what's going to generate that lifetime income stream. In order to be managed by a new investment advisor with a new strategy, we need at least a minimum of $1 million. So you can contribute to a current CPT for a smaller amount. We'll talk about that a little bit later, but we do ask to start a new CPT, to start a new young fund that Chris talked about that's less than 3 years old. We do have a minimum of $1 million for that administration. We cannot invest in tax-exempt securities or any UBIT producing investments. So we're really avoiding debt within this kind of instrument. The income generated each quarter within that investment is going to be distributed to the trust beneficiaries. So we define the income as interest, dividends, rents and royalties, short-term capital gains, and we usually use 50% of long-term capital gains. We'll talk about this a little bit more and how those long-term capital gains fit into this category. But we are using the IRS guidelines to determine what exactly income is. So every single quarter we're analyzing how the performance of the investment is doing, and that is what we are paying out to each of the income beneficiaries. All right, grant. So this is what happens at the end of the trust. So after all of our trust beneficiaries have passed away, the remainder is going to pass to a WaterStone giving fund to be distributed to charity. So the charity that issues the CPT must receive the remainder. That's something that makes these CPTs so unique and why you see so few charities running these, because the entire remainder is going to go to that charity administering the CPT. This works really, really well with our WaterStone donor advised funds. With our giving funds, you get all the flexibility of how you want that distributed to charity. You can tell us the timing you want that distributed. So all the benefits of the donor advised fund, you can tell us to distribute all of the funds immediately. You can tell us that you want the funds distributed over 15 years, or you can tell us to run it like an endowment. You want it to continue to live on, and we will just send out the income generated each year to the preferred charities that you've listed out. So you tell us exactly the charities, the percentages, the timing, There's a lot of anonymous options, so you can choose different levels of anonymity if you wanted to make, a larger gift somewhere, or you can have your successor advisors, your kids can manage where these funds are going to go after your passing. All right, so this is going to answer some of the questions that we've got coming in. We have one question about how much needs to be invested in order to have an advisor manage the funds. And so to have a new CPT with a new investment advisor to manage the funds, again, we'll need 2 donors. That can be a husband and a wife, but we do need a $1 million initial investment to create a new fund with a new investment strategy with you as the financial advisor. As far as joining one of our existing funds, we have more than 30 CPTs right now, including several young funds. So in order to join one of those current funds, we would request an initial investment of $100,000. And then as far as administration, so we'd be happy to send out our pricing schedule for what this administration looks like. It's a tiered schedule based on the balance of the pooled income fund, the Charitable Pooled Trust. But for that annual administrative fee, we will calculate all those quarterly income payments. We will send out those quarterly payments, usually by EFT, ACH. Sometimes we'll send them via check, and we'll send the donors and the investment advisors a quarterly statement showing exactly how that income and principal are performing. We will also provide a K-1 to each beneficiary. So at the beginning of the year, once we get the 1099, we'll prepare a K-1 that the income beneficiary can use to file their personal tax return. And then WaterStone, Chris here specifically, prepares and files all of the annual trust tax returns. So similar to a charitable remainder trust, the trust is its own particular entity, and we do need to file a trust tax return for each CPT. All right, I'm going to go through an illustration really quickly that we can kind of show you exactly how this works. I'll read through some of our questions real quick. All right, we do have one question about designing a deferral like a NIMCREP, where we're not using the income initially but can turn it on later. The nice thing about having it's an investment strategy for this pooled income fund is we can really invest the fund for exactly what income level we're looking for. So we will have quite a few that right now they're invested for growth. The quarterly income is pretty minimal. It's small amounts of interest and dividends because the primary focus is growth. 5+ years, the donors are retiring. We're now going to switch that investment strategy to more of an income focus investment strategy. We're now going to start seeing a lot more interest, dividends, and kind of control that income flow a little bit more. Again, it's going to be very variable, and it's based on the performance of the investments. And so the investment advisor has a lot of control over switching that investment strategy from growth to income. Anything else to add?
No, I think that's a good, when we start a new fund, we come up with a strategy, and as Stephanie said, it can be initial growth with income down the road, and we can kind of treat it like a target dated fund.
Awesome. All right. This is a screenshot of an actual illustration that we can run. So we are both CPAs. We love Excel. I particularly love Excel, the Excel guru in the WaterStone office. So a lot of our illustrations are custom to each client, each prospective donor, and we can really run them very particular to each client's situation. And so, this is a comparison of what it would look like to gift some appreciated stock to a charitable remainder trust, or what it would look like to do it to a charitable pooled trust. So we'll just kind of start from the top. And this is something that we can create for any of you as donors or advisors for any of your clients before you're meeting with them. So at the very top, there's a few income assumptions that we like to use. So the estimated market value here, we've got $5 million of appreciated assets that we're recognizing. In this term, it was it was some appreciated securities that we were going to need to recognize a very low cost basis, only $1 million of a cost basis. And then the other income. So this is, the W-2 income, the standard income that's going to be hitting your personal tax return. So this donor's other income for this particular year was going to be about $1 million. So what we were looking to do was to make about a 30% gift. 30% is a key number when we're gifting securities or appreciated assets, capital assets, because the charitable deduction is going to be limited to 30% of your AGI. So with cash, we typically have more like a 50 or a 60% limit on AGI, but with securities, we do have a 30% limit on your AGI. And we'll talk a little bit about that as we go. So here we're donating about 36%. We're putting $1.8 million into a trust. We are using top tax tier rates right now. These are current rates. As you all know, there's a lot going on with Biden's proposed tax return or tax proposal. Nothing is final yet. We are keeping a close eye on that, and we'll keep you all updated if we see any movement in that regard. But for right now, we are just using current tax rates. So federal income, top tax rates 37%. The federal capital gains tax rate is 20%, but there's also a net investment income tax that Obama implemented. That's 3.8%. So we're using that total 23.8% in this illustration. And then this donor lives in California. So normally 12.3% tax, but since it's over $1 million, we're looking at that. We're adding that extra percentage in there. So 13.3% tax. And then this is an individual. There's a husband and a wife. They are both age 65. And here you can see the difference between a CRT, the charitable remainder trust deduction, at 33%. And then the pooled income funds CPT deduction at 61.6%. So notice that chart that Chris went through, the younger the donors are, the more of a difference that you're going to see in the variation between the CRT and the CPT return. But at 65, we're right at almost double of the deduction percentage. All right, so if we move down a little bit, now we can get into the actual illustration. So what we're looking at here, the first column is going to be there's no gift at all. We sell all $5 million of securities. We pay all the taxes. This is worst case scenario. Middle column is gifting the appreciated securities to a charitable remainder trust, making a $1.8 million contribution to that CRT with the 33% deduction. And the final column is what it looks like to gift the $1.8 million of securities to one of these pooled income funds, to a charitable pooled trust. So we'll see here that by gifting the securities, we are completely avoiding the capital gains on that portion of the donation. So we are avoiding 36% of the capital gains. That's before we even get to the deduction. We are already avoiding significant taxes. Then we've got other income in here so that we can get to an estimated AGI. As I mentioned, AGI is very critical because that's going to determine how much charitable deduction you can use in a given year. Now, there is that 30% limit on the security contribution, but there's also a 5-year carry forward. So there's 6 years total that you can use this charitable deduction. Each year, it's going to be limited to 30%, but there is some potential carry forward here. In this particular scenario, we are not worried about any carry forward since we're gifting a little bit under 30% of our AGI. We can use the entire deduction in the year of the gift. So if there's no gift, you get no deduction, you're going to pay full taxes. If there's a charitable remainder trust, we get that 33% deduction, so we get a $600,000 deduction. With the CPT, we get a $1 million deduction. So, $400,000 greater of a deduction for this $1.8 million contribution into the charitable trust. So now we've got some tax estimates. So the deduction is first going to be used against ordinary income. it's going to offset that higher tax rate at that 37%, and then it will be used against any capital gains taxes. So you'll notice in these far right two columns, our capital gains tax is already significantly lower because we are completely avoiding more than a third of the capital gains. So we're already paying significantly less in capital gains tax. The ordinary income tax we're seeing is completely eliminated with this CPT. We are using all of the charitable deduction against that highest tier tax rate. So the estimated income taxes, if you go down a couple lines, there's estimated tax savings. Estimated tax savings is comparing against that no gift. So with the charitable remainder trust, you're saving more than $800,000 by doing the gift to the CRT. By doing the gift to the CPT, you are saving more than $1 million in taxes. So just keep in mind the deduction's not a dollar for dollar credit. It's an itemized deduction. And so here's where you can truly see that additional tax benefit of that higher deduction, that historically high deduction that you can get with the CPT. And we're going to keep in mind that the donor is still going to receive a lifetime income stream. So not only have we lowered our tax bill, and now the donor still has more to invest. The bottom section of this shows income from net proceeds. We're using a conservative 5% here. So if we are investing the net proceeds, the remaining of the securities that we sold outright, we're diversifying that portfolio, we're earning about 5%. We're still earning a very nice annual return, but we're also receiving income from the trust, whether it be a charitable remainder trust or a charitable pooled trust. We're still receiving $90,000 of income from this trust. So not only are we saving all those taxes, but we're actually going to be increasing our estimated annual income. So that very bottom line is the total estimated annual income. As you can see, our annual income is significantly more than it would be if we made no gift at all, paid all the taxes, and just invested those proceeds. All right. Feel free to keep the questions coming. We'll keep looking at those, and I'll have Chris move on to our next slide.
Okay, so Stephanie talked a little about income and a CPT, but I'm going to go through a couple examples. So I just wanted to give you a little background again on how we calculate income in a CPT, because essentially it's a net income instrument. We pay out net income. So by IRS code, dividends, interest, and short-term capital gains have to be paid out or they're taxable to the trust. You don't have a choice. If your instrument is not written that way, then you're going to pay tax on them. So every CPT says that dividends, interest, and short-term capital gains are paid out. Expenses, you have some flexibility, but it's the Uniform Principal and Income Act and what most trustees do is allocate expenses between principal and income 50-50. The key piece is long-term capital gains. The code allows you to set those aside for charitable purposes, so they do not need to be paid out. Whereas, again, if you don't pay out dividends and interest, the pooled income fund will pay tax on those. With long-term capital gains, you do not have to pay those out. So historically, long-term capital gains were not paid out in the pooled income fund. That's actually how our first few CPTs were written, that we didn't pay out long-term capital gains. We started to get a lot of questions of, it's really hard to earn a decent return in this environment just paying out dividends, income, and short-term capital gains. So we started to review the tax code, did a lot of research on long-term capital gains, ran it by our attorneys, and it's pretty clear from the code that it talks about, it gives you flexibility in how you define income. And long-term capital gains can be considered income. And several organizations pay out some portion of long-term capital gains. A lot of legacy funds do not pay out long-term capital gains. But we've kind of come to the conclusion that we're generally going to pay out 50% of long-term capital gains. And we kind of view our role as trustee. We've got two sets of beneficiaries. We've got the current income beneficiary and the long-term charitable beneficiary. Although, as Stephanie said, we are the charitable beneficiary, we're not the ultimate beneficiary. That money will come to WaterStone, but then it'll go out in the donor advised fund. So by paying out 50% of long-term capital gains, we preserve our principal, and we try to keep our income beneficiaries a little happier by getting a decent return. So why don't you jump to the next slide? So just looking at what WaterStone currently has, we have 31 CPTs, a little over 55 million in assets, and about 10 young funds. As Stephanie said, we have the ability to create a new young fund if we have $1 million, and this would be a new investment strategy. So if an advisor comes to us or a client comes and wants to use a different advisor, we'd have to review your strategy, but generally we can come up with a reasonable strategy that makes sense, and we could create a new fund. What I wanted to talk about here is one of our existing funds. As I said, we have 10 young funds, and here's one young fund just to give you an idea of some of the things we can do. So, we have some funds that are primarily in, let's say, stocks, dividend producing stocks, and some fixed income. And so from dividends now, you can maybe get 3%. And with the ability to pay long-term capital gains, if you get 3% from dividends and you have 4% growth, which is very reasonable, and we pay out half of that, if you recognize it, we can get to a 5% return, which is kind of in my mind what a good target is. But obviously, if you're that high in the stock market, there's a lot of risk. So I talked to one of our advisors and wanted to come up with a strategy that has a little less risk that we can still hope to get to 5%. So this is kind of our default strategy now. So if you came to us with 100,000, this would probably be the first pool I would suggest to you. As I mentioned, we have like 10 available, and if it's a larger amount, we could look at a custom pool. But just kind of going over this pool, it's got the goal in this one is to get an annual income stream of 4 to 7%. I talked to the advisor and said, I'd like to hit 5%, but I'd like to get it more diversified and reduce risk. So his target is 4 to 7. We've got a lot of diversification. We'll talk about the different categories we have, but this only has about 35% in stocks, and the rest is very diversified. It's also got a lot of asset-backed securities for inflation protection. I know there's a lot of concern about inflation protection. Even if we could get a bond that we're happy with today, a 20-year bond that pays out 5%, well, that's fine, but that bond isn't going to be worth a whole lot in 20 years when it matures because of all the inflation we're going to see. So this protects against inflation because we hope to have some growth as well. And again, WaterStone oversees this. We work closely with our investment advisors, but we hire professionals to do this. So we have a professional managing this fund as we do all 30 of our funds. So we go to the next one. So this is, as I said, this is CPTI, and it's got 35% in stocks and 65% in other investments. And what I really like about this, if you look at the risk factor similar to stock and the volatility, we see a lot of low stuff there. We've got some real estate backed assets, and that's an institutional fund that's very diversified. We've got a life insurance investment fund that's also, again, highly uncorrelated to the stock market, and another diversification. We do have some high yield bonds, but that's as the stock market would run into trouble, some of the bonds would run into trouble as well, but not as much as the stock market. So that's more medium correlated. And then we have a little bit of cash, money market. Then in the stock portion, we have two pieces. We have a dividend paying group of stocks. And again, those are generally less risky because of the stable dividends, but they are clearly riskier than some of the other classes. And then we have essentially a large index fund. I'm going to talk a little more about a couple of these pieces just to give you an idea of what we can do. So on the top, all of those investments not the cash and money market, but the first three are their historic yield has been well over 5%, and that's the target. Now, normal disclaimer, past results are not a prediction, no future guarantees here, but the target on these is to hit 5%, and we've seen that historically. This particular fund with all of these, we don't have a lot of experience. This is a newer fund, but we've been in many of these investments for a long time and seen how they performed. But the two key pieces we have there, in the insurance, we have the ability to, as we take money out of the fund, is when we recognize the income. So with this investment, it'll grow. We'll get a regular growth in the fund, but we don't recognize a dividend until we make withdrawals. So we have some flexibility. If we're having a bad year in the other investments, we can take out more in this fund. If we're having a good year, we can take out less. In our diversified U.S. equity portfolio, this is an exciting thing that we've just added because of the ability to hold fractional shares. What we actually hold here, this is mimicking a large index fund that holds maybe 800 securities, but we actually hold all the individual securities in a separately managed account. Now, this pool is big enough that it makes sense. It has to be big enough that it makes sense to do this, but what that gives us the ability to do is two things. The first thing is we were able to make this almost a biblically responsible fund. We didn't go into as much detail as some of the BRI funds out there have really complex screeners, but we were able to eliminate about 100 companies that did things that we were opposed to. So that was the first key. The second key is because we hold all these individual stocks, we have the ability to recognize certain gains. So, let's say the market's up 10%. There could be 100 stocks that are up 30%, and we could just sell those to juice up our return, or we could take some losses on the year if we need it. So it gives us a lot of flexibility in order to hit the 5% target that I've given to the IA, and I feel good that we can do that. So just a summary, this is a basket of investments subject to significantly different risk factors compared to a traditional stock portfolio. It's got less volatility, and we have a steady stream of income from this. And we've got a professional investment advisor and several institutional funds that have advisors as well. So, I really like this strategy, but we have 30 others. This is just one I chose to highlight, and we also have, a lot of other advisors we work with, and we'd be willing to talk to you about your own custom strategy.
Awesome. Well, we've got some time for some questions. We've had some really good ones coming in over here. So, we can absolutely create a new charitable pooled trust with a new investment strategy. So again, that $1 million minimum, and we do all of the trust documentation in-house. So there's disclosure statements and instrument of transfers and some different trust documentation that we will put in place. The disclosure statement will include a specific investment strategy for that CPT, what the goal for that CPT is going to be. We can always change it, but for the most part, we're just trying to meet the goals of what those donors are looking for. So we had one question about, setting up a CPT with parents and children, and how that would work to change the investment strategy from growth while the parents are alive to income when the children are receiving the proceeds. So it really just depends on exactly how you want that income distributed. The instrument of transfer is the document that we use to determine who's receiving income when, who the different survivor beneficiaries are, if it's going to be that the parents receive all the income for their lifetimes and then the children receive income, if parents and children are going to receive income all at the same time. Typically within that disclosure statement, when we're talking about and setting up the investment strategy, that's where we're using, this is what we're planning to invest in, this is the goal for the funds, in 10 years or a certain timeline or a certain time is when we're going to plan to kind of flip how how everything is invested. And then I know that we've got lots of questions about just changing taxes. So we've already seen in Colorado a limitation of itemized deductions. That's Colorado state specific, but that is right off of Biden's proposal to start limiting some of these itemized deductions. We're not sure exactly how it's going to work, but for Colorado state, there's already a law limiting itemized deductions, which includes your charitable deduction. If you make more than $400,000, limiting that to $60,000 if you are married filing jointly. And so we have a lot of people that are wanting to make large contributions to CPTs, donor advised funds, CRTs before the end of the year end, before the end of 2021, before a lot of these new limitations would be in place before 2022. So we had one user, Kelly, thanks so much for reminding us about that limitation, that we're going to potentially see the PEAS limitation coming back in 2022, a limit phasing out itemized deductions for high income taxpayers. So we have a lot of people making some decisions here in 2021 about the uncertainty of taxes going up and how that's going to apply in future years. So as long as the contribution is made to the CPT before the end of the year, you will get that deduction this year before any of the deductions are going to be limited further than even the 30% limitation. So,
and as you know, we don't know what's going to happen there. We expect taxes are going to go up in some form, either through taxes being raised or deductions being limited, or probably both. But as a couple of you know, now's the time. We know what we can do right now. So right now is a great time to give. We know we can get our deduction now. We're not sure what it's going to look like in a year or two. It could be just as good, could be better, but we know with certainty what it's like right now.
Yes, and just to clarify, that Colorado state change is effective beginning of January 2022. We've also still got the CARES Act extension through 2021, so a lot of benefits to take advantage of before the end of 2021. So feel free to keep sending questions in. Chris and I'll stay on for a little bit longer to answer any questions that you have. We're so thankful that you took the time to join us and learn more about these charitable pooled trusts. As always, if you have any questions, please don't hesitate to reach out to us. Ask for one of us by name when you call in on our main line, and we'd be happy to run some of these illustrations for you, specific to your scenario and your charitable goals. Anything to add?
I think we're good.
All right.
If you're still on, we this was our first webinar. We hope to do these at least quarterly next year. So feel free. We have several topics in mind, but feel free to give us any ideas down the road.
Yes, we have been recording this presentation, so I think you should all be receiving a link to the recording once we finish. If not, feel free to reach out to me or Chris, and we can send you a link to the recording. We'll plan to post it on our website and be able to share it with more folks that weren't able to join it this time today. And yeah, hope to be able to do more of these webinars in the future. Feel free to reach out, provide feedback if there's any topics that you want to hear about, anything that we can help discuss. All right. Thank you so much, everybody.